Good morning, everybody. I want to thank you all for the little delay here. Want to welcome everyone to our Affordable Care Act, Avoiding Costly ACA Fines and Penalties. Our wonderful guest presenter is Jonathan Jubb from AALRR. He has an emphasis on employment law and a specialty on the ACA. He is our guest here today. He's going to be going over what we're seeing in right now in regards to the IRS fines, what to prepare for, and also to what you should be prepared for as well too. Again, we will have some questions and Q&A at the end, but now I'm going to be handing it over to our guest presenter, Mr. Jonathan Judge.
Hello, Tony.
Yes,
Can you hear me?
I can.
Okay, great. Well, welcome everybody. And we want to talk to you today about what we've been seeing with the Affordable Care Act. It's open enrollment season for 2019 now, and we've been dealing with this for a long time, but it seems like, just seeing the first, go around with regard to penalties from the IRS. So we're going to do a little bit of review here as to where we were a number of years ago and where we are today and what we may anticipate in the future. So believe it or not, it's been almost or over 8 years since the law was passed, dating back to March 23rd, 2010 was the first big bill, the PPACA, and then a week later they passed a little shorter reconciliation bill to clear up a couple items in it. But that is the legislation that we've been dealing with, and there hasn't been any amendments, and despite all the threats, there hasn't been any repeals of it since that time. So basic overview for everybody. Large employers are affected by this, and that means employers with 50 or more employees. Smaller employees with 49 or less employees are not obligated to offer health insurance to employees, but there were certain tax breaks that were available under this law for employers with 25 or less employees. That never developed into anything really significant that many of my clients took advantage of, but it may have been something that was handled by their CPAs, and I didn't get involved. So what does it mean to be a large employer under the ACA? Well, it is 50 or more full-time or full-time equivalent employees. And, we're still getting into this because some employers will be getting these notices from the Covered California that may be being sent to smaller employers. And all of a sudden they panic because they think they're covered by the ACA, or they were in 2015, and they're getting this notice that the employee is generating a potential penalty. And recognize that is generated by the state, and it's generated by information that the employee is given to the state, so it may not be correct. We'll get into the details on that in a little bit. Under the ACA, it's one of the unique laws that defines full-time employee as 30 or more hours per week on average, or 130 hours per month is considered full-time under the ACA. Independent contractors are not employees, but don't think of this as a good reason to classify folks as independent contractors. As we know, we got a very bad decision from the California Supreme Court on that earlier this year in the Dynamex decision that makes it more difficult for employers in California to establish independent contractor relationships. And the bottom line is there at the top, large employers must offer full-time employees health insurance coverage. or they'll pay penalties. And that's the basics of it. We'll break that down in a little bit more detail in the following slides. All right, so when we talk about the ACA, and this is going back to the way it was in 2015, or really, before that when the law was first passed, that we talk about two penalties, penalty A and penalty B. And penalty A is kind of what we call the nuclear option penalty, or the nuclear penalty. It's the big one. It is if your company does not offer health insurance to 95% of its full-time employees or more, then it will be hit with a $2,000 penalty per full-time employee that you have, whether or not they got insurance or not. There was a 30-employee exclusion. So for your mid-sized companies that maybe just over the 50-employee mark, then if you exclude 30, you can see the penalty is not going to be very great. But if you have 1,000 employees, full-time employees, the 30-employee exclusion is not going to do you much good. Penalty B is a little bit more complicated, and this kicks in if you offer health insurance to your full-time employees, but it's not either minimum value or affordable. And we'll go into that in a little bit more detail in the next few slides. If you have those two factors, and then an employee goes to the California exchange or some other state exchange and signs up for the exchange coverage and receives a subsidy from the government, then they will generate a penalty. And there, it's not a penalty for every full-time employee, but rather it is a penalty for each employee that falls into that situation. And the dollar amounts on here are subject to inflation. So the penalty for 2015 is a little bit over $2,000 per year for each full-time employee, and a little bit over $3,000 per employee for the penalty B. To further complicate matters, it's divided by 12. It's assessed on a monthly basis, so you're not going to see these numbers on the penalty assessment unless you dig into the numbers a little bit deeper. So when we talk about affordable coverage, they implemented a number of safe harbors into the law way back in 2013 and 2014 when they issued regulations on this. And they've stuck with these safe harbors since then. We got three basic safe harbors. You got a W-2 safe harbor, you got the rate of pay safe harbor, and the poverty line safe harbor. And what these are tests to satisfy, to show that your health insurance is affordable. And what that means is that the employee's share of the insurance premium, the monthly premium that they pay, should be no more than 9.5% of their income. And way back in the day, the IRS recognized that it was going to be difficult for employers to prove up what an employee's household income is. So in lieu of doing that, they came up with these safe harbors. The first is based on the W-2 and the earnings. The second is based on their rate of pay, and a multiplication is involved there. And then the third is the least beneficial one for employers, but it's based on the federal poverty line. It kind of creates a base rate of pay of contribution that's really low that will satisfy the requirement. And on this slide, we go into some examples of the calculations that would have been in effect for 2015, based on these three safe harbors and the numbers that were involved at that time. So you can see there in the W-2 they look at the employee's wages in box 1 of the W-2. You divide that by 12 for a monthly amount. Then you multiply that by 0.095%, which is 9.5%, to come up with a dollar amount, 164.67. So to satisfy that safe harbor, the premium that must be paid by the employee must be no more than 164.67. If it's more than that, then the employee is being asked to pay more than the 9.5%, and it would be considered not affordable for the employee. Compare that to the rate of pay safe harbor. You got the same employee here earning $10 an hour. Keep in mind, this is no longer the minimum wage in California. This is 2015 numbers. But you do the calculation there. You take their rate of pay times 130, which is the coincidentally or not the what is considered full-time under the ACA for a month, and you come up with 1,300. So 1,300 for the month, you multiply that by 9.5%, and you get a dollar amount of $123.50, meaning that if the employee's share is more than that, then you're going to owe a penalty because the plan is not affordable. If it's less than that, then you're in the clear. Then finally compare that to the federal poverty line. This is based on statistics that the federal government puts out every year. It's going to be higher for 2018, but back in 2015, the federal poverty line that they used was 11,770. You take that amount divided by 12 to come up with the monthly amount. Then you multiply that by 9.5%, and the threshold there is $93.20. So you can see it's almost half that of the W-2 safe harbor. So a lot more beneficial to use the W-2. It's a little bit more complicated to do it, but it can work in your favor. All right, so moving on to the next slide. All right, so this was the requirement back in 2015 that a large employer, applicable large employer, must offer health coverage to full-time employees and their dependent children or face a penalty A or B. Then also on top of that, you needed to track data throughout 2015 and file the 1094C and 1095C in 2016. So that's that's laying the groundwork for where we are today. And if you're getting penalty letters from the IRS, it dates all the way back to 2015. And when I was talking about this law back in 2015, I was talking about a 3-year window that employers were dealing with. And I explained it this way. You would have 1 year where you're determining your status, and so that was 2014. You were determining whether you're a large employer or not, and that would be the determination for 2015. And you're looking at an entire calendar year there. And then you're tracking all your data for 2015, and then in 2016, you report for 2015 to the IRS. And so now we can extend that, thought exercise to 3 years down the road from 2015 that the IRS has been issuing these penalties. And it may be really that they started in 2017. So 2 years, it took them at least 2 years to start generating penalties on the 2015 reports. Recognize that, under the IRS, you're typically reporting in April or earlier in the year with regard to ACA issues. So December 2017 is when one of my clients received a 226J letter from the IRS. So, if you do the math there, it was probably at least 18 months between the filing with the IRS and the time that the letter from the IRS assessing the penalty was generated. So you got to keep your record for a long time is the moral of the story there. All right, so a little bit more of basics on reporting. We've got a whole alphabet soup of forms here, different numbers, different letters, A, B, and C. The 1095A and 1094A would be generated by the state or federal ACA health exchanges. So I haven't seen any in person, but I would imagine covered California if you had someone who purchased health insurance through them would be issuing that form with an A at the end. The B form is issued either by the insurer or by self-funded employers. So most of you, if you're fully insured, would not be getting involved with the forms that end in B. But your employees would be getting a 1095B form from the insurer with regard to that fully insured insurance. Then finally, C is where the employers get involved. Large employers will be generating the 1094C and 1095C. You file the 1094C with the government, and then you file the 1095C with the employees and with the IRS. All right, so here's what the form looks like. This is the first page of the 1094C. And this has been changing a little bit every year depending on the different regulations that are in effect. Back in 2015, there was a number of transition relief options that were available. You can see there on line 22, there were 4 options there with regard to different types of safe harbors that were available. I believe a few of these have gone away based on the ACA being in full effect now and not just transition years. But yeah, we've seen some errors generated for the 226J letters from the IRS. That is the penalty letter, based on some errors that employers made with regard to line 22 and checking the wrong box or not checking a box when they should have. So this is the second page of the 1094, and this is really where we've seen a lot of the errors with regard to the 226J letters that have been coming out from the government, and either errors caused by the IRS themselves or by the client not understanding what to put in there. I've handled 5 of these so far, all different pretty much. That first one was interesting. They had checked yes on all 12 months up here on line 23, but and then left all the lines 24 through 35 blank. Neither yes nor no were checked, but they were offering health insurance to all their employees, and they did it for the entire year. And for whatever reason, the IRS read that as a no for each of the 12 months and hit them with a $258,000 penalty. So we filed an appeal on that company's behalf and said, hey, you guys screwed up. You should have read this as a yes for all 12 months. And the instructions said if all 12 months was the fact, that all you needed to check was line 23. And so that's what we did. And the IRS penalized us contrary to the instructions. So that just required a short explanation to the IRS, and they reversed that penalty. Another area we saw that there was a mistake. We had one client who had an October plan year start date. So they left blank a number of boxes on the 1094 here, but they were eligible for the transition relief that was available for non-calendar year plans. And so they should not have been hit for any penalties, into October. And really, they were offering health insurance to all their employees, all their full-time employees. So they just made the mistake of not checking the box when they thought they were eligible for the transition relief, and thought they didn't need to check it in that case. So we were able to get a $48,000 penalty there reversed. In another case, we had lines 23 to 35 checked no instead of yes. Again, the client did not understand the instructions correctly. That was a $26.4 million penalty that was reversed. And just a simple explanation to the IRS that the yes box should have been checked for all 12 months. Then we had another client that had a mid-year plan. They'd left lines 24, 25, and 26 blank up here. And they should have checked yes. And so we were able to get that reversed, and that was a $1.2 million penalty. And then finally, we had our most recent appeal. We're still dealing with that, almost a year since these letters have been generated. But that was a client that checked off the transition relief where they didn't need to, because they had been offering health insurance back in 2014 and before to all their employees, regardless of whether they were full-time or part-time. And it was minimum value, it was affordable, so they should have checked the safe harbor. They checked the transition relief, and for whatever reason, the IRS triggered that as a penalty against them for a handful of their employees. They had, 3,000 employees plus, and they were hit with a penalty for about 80 of them. And, it's just a few fell through the cracks and were generating penalties just because some of the coding was not what the IRS wanted. But, looking through these things, they're far from clear from the IRS instruction standpoint. And the good news, bad news is the IRS learned from its mistakes in 2015 and clarified some of the instructions for 2016. But, it's just now that we're learning, what the IRS was looking for and what they're penalizing for. So it's, what are you going to do about 2016 if you filed it incorrectly? That's going to be something that you'll have to discuss with your counsel or CPA. But the other good news is that IRS has been very lenient on 2015 and reversing penalties pretty much based on a short statement back to them saying, hey, you guys screwed up, or we screwed up, but we didn't understand what the instructions were. So I don't know if they're going to be so forgiving for 2016. Officially, they've said they're not going to be, but they're always constantly changing their story on that. So some things to keep in mind. So here's the here's the 1095C form. In that most recent case, we saw a lot of the errors generated off of what was being reported on lines 14 and 16 here, as to the different codes that go in there. So back in 2015, here are the 9 different codes that were available to put into line 14. And this is a good, checklist to use, for 2015 if you had any issues with that. Then line 15 is only completed if you have a dollar amount to put in there, and only triggered if you put in code 1B, 1C, 1D, or 1E on line 14. Then line 16 is where you're kind of saving your butt, so to speak, with regard to the penalties, because you're either going to be indicating that someone was not employed, they're not a full-time employee, they were in the waiting time period. We found that was pretty effective to remove the penalty. And then to E, also multi-employer interim relief rule. And then you got your safe harbors 2F, 2G, and 2H. And all of these codes, if you're indicating them, are going to negate the penalty for the employee if they're generating a penalty. So a little bit more detail here about everything that goes into the calculation of the penalty. For 2015, when we talk about the threshold for offering health insurance to full-time employees, one time only they reduced that from 95% to 70%. So you may see some of the numbers a little bit different back for 2015 if you were assessed with a penalty. But recognize there on the second bullet point, you'll be hit with a penalty only if at least one of your full-time employees enrolls in an individual marketplace here in California, that's covered California, and they receive health insurance coverage assistance, also known as premium tax credit or cost-sharing reduction, i.e. a subsidy to pay for that premium. And they can only get that if their household income is between 133% and 400% of the federal poverty line. So it's going to exclude your very poor employees, and it's going to exclude your very rich employees. But anybody falling within that band may be able to get subsidies, and if they get subsidies, then that could trigger a penalty for the employer. So there's the basics of the penalty. You can see there, even for 2015, it went up a little bit with inflation to $2,080 per year for a full-time employee. And then there was another transition rule for 2015 only. Rather than excluding 30 full-time employees from the penalty, they excluded 80 full-time employees from the penalty. So, even more small employers were left out because of this from any penalties for 2015. Penalty B, we talked about that. This is triggered if the employer offers enrollment in MEC, that's minimum essential coverage, to at least 95% of the employees. You get out of penalty A, but you still may be vulnerable to penalty B. And that would be if the value of your coverage is not minimum value, i.e. You're offering a bronze coverage or more, and this is based off of calculators and actuarial values that the government put out way back then, or the coverage that you're offering is not affordable, and that's the 9.5% threshold that we talked about. And if at least one of your full-time employees enrolls in coverage at the marketplace, that will trigger a penalty. It'll be $3,120 per individual who does that, who meets all three of the above requirements, or the $2,000 penalty per full-time employee, and whichever is less of the two is the penalty that you'll be hit with. So with regard to the penalties that we've been seeing, or the penalty letters that we've been seeing, at first it was going out in waves, and they were assessing penalty letters for penalty A only, and then they were reserving the penalty B letters for a later date. But now we're seeing kind of a hybrid that they're assessing both at the same time. So it could be that they're assessing A and B at the same time, or just they're skipping over A and going directly to B. We had that with one of our situations where we were able to reverse the A penalty, and they assessed a B penalty for 3 employees. It ended up being about $14,000 for the entire year, and so it was just something that they decided to pay out rather than paying off for the penalty. All right, so what does it mean to make an offer of coverage? And Tony will have a little bit on this at the end of the presentation. The IRS regulations say that an employer makes an offer of coverage only if the employee has an effective opportunity to enroll in coverage at least once each plan year. And what season is it right now? It is almost Christmas if you watch all the commercials on TV, but it's also open enrollment season, and this is when your offers are going out to the employees. And you want to make sure that the offers are going out, even if the employees are going to re-enroll and sign up for the same coverage next year. You want to give them that opportunity to disenroll if they are so inclined. And so whether an employee has an effective opportunity, according to the IRS, depends on the facts and circumstances, including the adequacy of the notice of the availability of the offer, the period of time during which the offer may be accepted, and any other conditions on the offer. Beyond that, we don't have much guidance on this from the IRS. At least with regard to the 2015 penalties, they haven't even asked me yet for any proof of offer yet. So, that is what it is. But down the road, if they become more aggressive, you may want to have that proof that the open enrollment package was sent to the employee, and when it was sent and how it was sent, etc. All right. A word on this, the penalties and the offers, before I move on. Some of you may have received a letter from Covered California. I've got one here in front of me that was sent to one of our clients, and it says, you are getting this notice because your employees on the attached list below was determined eligible for advanced premium tax credit. So that's the subsidy from the federal government for purchasing and enrolling qualified health plan, QHP, through Covered California. So this can be alarming for an employer, but so keep this in mind. It then says applicable to large employers with 50 or more employees are subject to the ACA, et cetera, et cetera. Talks about what is a full-time employee, talks about affordability and minimum value standards. So here then it says, large employers may be subject to a ESR penalty. That's from the IRS if at least one of their full-time employees receives a credit for purchasing or subsidy for purchasing health coverage through Covered California. And then here's the important part. It says if client name is a large employer and the employee on the attached list is determined to be a full-time employee under the ACA and was not offered an opportunity to enroll in employer-sponsored health coverage, or if the health coverage did not meet the affordability or minimum value standard for any month during 2018, the IRS may determine that you are subject to an ESR penalty. So it's not saying that you're going to be subject to a penalty, except if you meet all those conditions in the letter, that you're a large employer, and that you're dealing with a full-time employee on this list, and that they were offered health insurance or not offered health insurance, or they were offered health insurance and it wasn't affordable in minimum value. all the basics that we've been talking about in the slides today. If that happens, then you may be hit with a penalty by the IRS. So from what I can tell, this letter is generated off of information that the employee is providing to Covered California, which oftentimes may not be accurate. And this is also going out to, in at least one instance, one of my clients with less than 50 full-time employees. So basically, I told them, look, you're not subject to any penalties under the ACA, so you can ignore this. You're not going to get penalized by the IRS. But you have to pay close attention to your numbers way back in 2015 to figure out whether you were above 50 employees at that point. If so, you may be getting a letter from the IRS. There is an opportunity, if you are so inclined, to appeal the Covered California letter and their determination. The appeal goes to the U.S. Department of Health and Human Services, and then get this, they say that, however, filing an appeal will not necessarily affect your liability to make an ESR payment to the IRS. Only the IRS can determine whether you are subject to a penalty. It says that in bold language. So I have yet to walk a client through this process yet, but ultimately it's the IRS that determines the penalties. This may be an opportunity to nip this in the bud, so to speak, if you've received this and you can, for sure say, hey, this employee was full-time, they were offered health insurance, they shouldn't have generated a penalty. The appeal process may be an opportunity to kind of take a proactive approach and get that item corrected with the government. So with that, we're going to move on to a couple of new issues, what we are looking at in the future with regard to the ACA. And to look forward, we have to look back to the 2015 Supreme Court decision, 5-4 decision, remember that, King versus Burwell, and that was the challenge to the ACA. And the key part of the ruling was that they found the Affordable Care Act constitutional. They upheld the individual mandate, that is, the penalty that was assessed against individuals for not having health insurance. Now, one thing to look forward to 2019 is that the individual mandate is going away. That was eliminated. So there's no longer going to be a penalty against individuals for not obtaining insurance. So the effect of that is going to be interesting. We'll see the effect of that now with open enrollment going on in the individual marketplace, and see if as many people sign up or not, because they're not going to be penalized next year. Whether they're aware of that or not, I don't know. But that may have some impact. It may have a detrimental impact on the ACA marketplaces. The other part of that ruling was the Medicaid expansion. And one of the rules under the ACA when it first was passed was that it was going to expand Medicaid to poor individuals that were below a certain level of the poverty line in income. And one of the things that the Supreme Court said in this ruling was that to make that operable, each state should have their choice as to whether to opt in or opt out of the expansion. So as a result of the decision by the Supreme Court, in states that do not expand Medicaid, the impact on employers is that they may face greater exposure to tax penalties because lower wage employees who would have been eligible for Medicaid may instead be entitled to a subsidy through the exchange. And where that happens, as you can recognize now, the employer can get hit with a penalty. So it would have been beneficial for employers to be in a state where they opted into this requirement and expanded Medicaid, because it would lower the population of folks that are generating penalties. Fortunately for employers in California, California opted to expand Medicaid. All in all, we see about 33 states, including California, expanded to include Medicaid, expanded eligibility for Medicaid. 14 states did not, or are currently not following that directive. And then 3 states have it on the ballot next week and will be deciding upon it, whether to expand or not. That's Utah, Idaho, and Nebraska. So, and it's a lot of red state versus blue state here, but you can see that a few of what you would consider red states are considering going to expand into the Medicaid. Then another couple of developments that just came out within the last couple of weeks. There are a couple proposed rules. One was going to help the ACA. The other one is to the detriment of the ACA, and it both come out from the Trump administration, which is interesting. The first would be a proposed rule which would allow employees to use HRAs to purchase exchange coverage. So this would allow the employer to contribute money to an HRA and allow the employee to use that money to purchase an individual coverage through the state exchange. Right now, a lot of employers pre-ACA were doing things like that, where they were a smaller employer. This was called a premium-only plan, and what would happen there is the IRS said you can't do that anymore. It's an ACA violation, and it resulted in a $100 penalty per day per employee. So you're talking $36,000 penalty there for offering this type of coverage. So this would be a way of revamping that and allowing some tax advantages as well to do that. But this is not something we're going to see until 2020 at the earliest, if this rule gets passed and approved. And the other rule there, the second bullet point, would be detrimental to the ACA and to the exchanges. And this would allow the expansion of subsidies to skimpier plans, that is, plans that do not meet the minimum essential standards of the ACA. So it may not offer a full benefit list of hospitalization or prenatal care or pregnancy care, for example, and it may be more limited. But these are kind of emergency plans that an employee can sign up for that are currently available under limited duration and without subsidy. This would expand the amount of time that the employee could enroll in such coverage and also allow them to get subsidies for such coverage. And the thinking here is it would erode against the insurance companies getting the full premium for full insurance, and you're going to just have a bunch of sick employees with the pre-existing conditions opting for the full insurance. You're going to have your young and healthy employees opting for the skimpier plans, and then the plans on the full insurance is going to go a lot higher for everybody, and then enter into one of those so-called death spirals of premium inflation. So there's a lot up in the air on this, constantly changing. But for now, we're dealing with penalties in 2018 on tax returns that were generated in 2015 or filed with the government on 2015 data. So with that, we'll talk. Tony, do you have anything to add here?
Jonathan, thank you so much for all of the information. One, just as a reminder for all of those, hopefully your payroll system has a functionality to be able to give you an eye on those that are considered variable employees. So you're doing the correct look backs and offering them benefits if you need to, but also too to make sure you're doing your annual look backs before as you're getting prepared for open enrollment. Jonathan mentioned documentation. I think my middle name is documentation. But in regards to open enrollment, you have a lot of um, model notices, required notices. And one of the things that we really want to educate people on is if there is an amount that people are required to pay for their benefits, that you clearly state that you have a Section 125 plan, you have all those opt-in and opt-out provisions, but also too educating your employees during open enrollment and letting them know where you are in regards to ACA. Let them know that you are far above what's required as far as the minimum value, but also too how much you contribute and what you could be contributing in regards to affordability. Also, too, letting them know that this is their opportunity to enroll, but they do have a select amount of time. So, a lot of employers that I get, they usually ask me, "Well, I can't put a gun to someone's head. I know it's a lay of the law that everyone's supposed to have health insurance, but if they clearly cannot afford it, what is my obligation? What is my, I don't want to get dinged because this person didn't take it." I said, "You're offering it, you're making it available, and you just need proof." As you're filling out these forms, they may come back and ask for backup. And just say, making sure you are here, you were at open enrollment, we offered it to you at minimum value, it was considered affordable, and you're considered a full time employee. So I think documentation is critical. We've seen throughout the years people saying, "Well, I just want to drop all the benefits now." And then you may have to give them the remember this form. We talked about the Section 125 plan limits you when you can make those changes. Or someone saying, "Well, now my teeth hurt. Now I'd like to enroll." And you can take out the form, download the form, look at your, your HRIS system, and say, "Unfortunately, that was the time frame. That's when you could have enrolled, and unfortunately, we are not able to allow you to enroll as a late enrollee at this point." So documentation is the biggest one. I do have one question for you, Jonathan, and hopefully you can help me.
Okay.
Um, I know that as a broker, for us, the easiest way to calculate the affordability is saying to people, "Well, who's your lowest paid employee and doing the 30 hours?" Um, in regards to the W 2 side of things, if someone says, "Well, nobody works 30 hours, everybody works 40." Now, I mean, this is coming from HR or the CFO telling us this. We don't guarantee it. We don't know for sure. We don't have their payroll records. If they say, do the calculations based on 40 hours, should we be taking a look at the old W-2, or should we just be taking the word of our employer and saying, "Okay, well, if we're doing it by the hourly and the 40 hours, well, then that would be the affordability safe harbor for W-2s versus lowest paid employee. This is the dollar amount per hour, and then times in it by the 30 hours." Um, what do you think is the easiest, or I guess easiest for employers to pick and choose, and then also rolling it out for like appropriate deductions for open enrollment?
That's a good question, Tony. The the least risky option there is the rate of pay safe harbor, and that you base it off the employee's rate of pay, and calculate the amount that the insurance needs to be at based on that, and that gives you a line in the sand that you can deal with, and it may be more than you need to pay in some instances, but it does offer you that protection that it even if the employee's income falls below that for whatever reason throughout the year, that it is a good safe harbor. The difficulty with the W-2 safe harbor, and I don't know if I've had any employers use it, is that it's prospective, and that you really need to know what your W-2 income is going to be able to use it. So you really have to have that absolute predictability that the employee's W-2 wages is going to be the same this year as it was last year. And if there's going to be any significant fluctuation there, then that may not be a very good safe harbor to use. And sometimes it's you deal with the data that you have when you're filing, but as a broker, you're always thinking in the future, and we're doing open enrollment right now for 2019, and we're not going to be reporting on that for another few years. You have to ratchet back to that conservative approach, to minimize the risk that you'll be hit with a penalty, a few years down the road. So that would be my answer on that.
Okay, perfect. No, thank you so much. I appreciate your in-depth overview. You've been, I guess, helping a lot of employers right now. If anybody here comes across those letters, again, they are somewhat scary. This is the first time you're seeing them. We're going to be seeing these year after year. So obviously, doing things the right way, then potential of you getting these letters, lessons as well. But if you do get them. Jonathan has been a wonderful resource to our clientele. We feel very, very comfortable in his overview, responses, and helping them. Also, too, if you need assistance with any of your benefits needs, please let us know. We will be having some events coming up in the future. Be on the lookout for those. But thank you so much for Jonathan. I appreciate your time today. Thank you all that were in attendance. And you have both of our contact information. If you'd like to get more specific information or assistance with what you're dealing with right now, please let us know. Thank you so much, Jonathan.
Thank you, Tony, for setting this up. And
Thank
have a
you.
good weekend, everybody.
You too. Bye bye.
Bye.